Ladies and gentlemen, welcome to this new episode of Stoic Talks. This podcast is presented to you in collaboration with DSP Mutual Fund. Our guest today is Gaurav Sud. For those of you who have been following us from earlier, would know that we started our first series with Gaurav himself. We have come a full circle. Well, Gaurav is a very versatile individual, one of very rare who have excelled in two totally different fields altogether: value investing and options trading. Now, in our last interview, we extensively covered his investing journey. In this one, we will try and dig deeper into his options book. Listen in.
All right, welcome Gaurav, welcome Siddharth. Great to have you both here again. Gaurav,
Thanks for having us.
I think if we are not wrong, we did first recording in 2016
Yeah.
in IIT Delhi. I think it was IIT Delhi if I'm not wrong.
Yeah.
IIT
IIT Delhi or IHC, I think
It was
were-
IIT Delhi.
I think I had an office there where I used to work and
Yeah, okay. Now I
Yeah,
remember.
very well.
Yeah,
In fact,
sorry.
we've come a full circle. For those of you who don't know, we started our podcast series with Gaurav Sud,
Acha, Gaurav was first.
Yes.
Okay, great.
and now we are again restarting it with our first video
Yeah.
podcast now with
Yeah.
Gaurav Sud. Yeah.
So, Gaurav, what we'll do is, since a lot of your journey has been captured, in a couple of places where you have given long form interviews, we will probably do, let's call it, sequel to that previous podcast,
Sure.
where we finished the first postcard discussing your journey throughout your initial years, your first couple of multiple multi-baggers, and at that time you were dwelling into options and risk arb for 3-4 years, and now from that time, I think 2016 onward, it's been 6 odd years. I'm sure you have evolved in that space also. So what we'll do is we'll take, and Siddharth, you have been with him from 2016 if I'm not wrong.
Yeah, that's
Yes,
correct.
right. So,
Yeah, that's
so
right.
both of you are doing this together. So I think it will be a great input from both of you, right? So what we'll do is, let's now start from current situation. Currently, you are managing your own portfolio, right? You are not managing any outside
absolutely.
capital. Okay. So when you're managing your own portfolio, how does your portfolio top-down start from asset allocation perspective?
So, just to give in context to where the earlier conversation ended and what, at that point of time, there was a lot of focus on my part on special situations. And those portfolios were doing pretty well in terms of the percentage return. So the binding thesis there was one particular transaction or a trade may lose money, but overall on a yearly basis, the returns were pretty decent. Now, what started happening from 2015-16 onwards, this entire set of trades started becoming popular as a category. And many people delved into it, and just the sheer number of people coming it, the brokers making those schemes popular among, like the tender buybacks, became a retail product being popularized by brokers themselves. And because of that, what happened was that the returns started going down. And also the frequency of those transactions started going down. Another phenomena that started playing out from 2016 was in open offers, typically you make money if the market price is below the open offer price.
Yeah.
But what started happening was, because of the bullish sentiments, the market price would overshoot the open offer prices. Then the arbitrage angle just went away. Then it was a bet in terms of what the company would do under the new owners. So, and that was not an angle that I was playing for. So my ability to participate in a lot of those things went down.
And is that still the case? What do
That
you
is
observe?
still the case. I think there's a different set of people who are now playing those strategies in a different way. They feel that the open offer price now is the support.
Yeah.
It kind of forms the bottom of their long bet on that stock.
Yeah, it's a management change theme that they're playing.
So it's a different way of looking at things, which I never really participated from.
And this phenomena is for across all the strategies, open offer, buybacks, rights issues. I think
So on buybacks, as I said, it became a very popular product, and so the returns obviously went down. Even on rights issue, what happened is post-pandemic, earlier what used to happen, a lot of retail guys did not participate in rights issue, purely out of lethargy, ignorance.
Lack of awareness.
Sure.
But what happened is after COVID, the rights entitlement itself started trading on the stock exchange.
Right.
So that if somebody who was planning to do participate in the rights issue, would simply sell his entitlement into the market.
Correct.
So what that ensured was that the participation levels went up pretty high. So the extra allotment that we used to get in rights issue just went away. So the rights issue as a special situation itself, the returns went down dramatically.
Just to close this, the reason. So the reason is popularity reducing your, the allotment which you used to get in all the cases, and also the price movement happened much faster.
Over allotment. So you play for right where
yes,
the basically the advantage is that what your allotment you can get, you apply for more, and the over allotment that you get is what determines the returns from those shares, because typically a rights issue comes at a discount to the market price.
Sure.
So that's where the arbitrage live. So that went down, and because of that, the returns simply were minuscule. So I played many ones, but I just realized it's not worth now spending so much time on.
So is it part of your day-to-day tracking at all now, or is it?
So my tracking, close day-to-day tracking, I used to have elaborate trackers on all these special situations. They definitely have gone down.
Okay.
So as an effort. So Siddharth has also been participating along with me. Siddharth, what your experience has
I
been?
think it's very similar. So basically, it is difficult to gainfully deploy capital for extended period time in special situations, because a lot of these special situations are not that lucrative anymore, and so the risk element today is higher. So for instance, delisting or open offers. So today the price is already above the open offer, so you are playing for much higher returns, but the risk is higher. It's not a risk arbitrage anymore. So it is a different kind of trade.
Sure.
So I mean, it could be it's a different trade other than a special situation. So we started to, because our focus was different when we were doing these trades. So we started exploring what other opportunities are available for income generations rather than special situations.
So this is very insightful. So what you're essentially saying is that the alpha in the rights issue basically vanished, because now the concept of brain dead investors, the non-participants, has gone away, because now they can sell it in the open market.
Absolutely. So even if the guy is lethargic or brain dead, as you point out, the broker will send out a mail saying that participate, or the dealer from the broker will call ki entitlement. There is a nudge from the depository saying that these will be worthless tomorrow.
Right.
Act on these.
Right.
So all these nudges have made people participate.
The same people who used to call in 2015 asking कि यार ये stock कैसे लेना है.
हाँ जी.
Now they call and say कि यार इस rights issue में कैसे apply करना है.
Yeah, exactly.
So the questions have, as you're rightly saying, and they get this information primarily from their brokers only,
Yeah.
who keep on telling them that you should do this, you should do that, and they call.
So yeah, with the evolution of social media and the information arbitrage, if we can call it that, because some people just didn't know what needs to be done. Now just one search on Google, everything is elaborated, and people realize that if there's money on the table, why should you leave it?
Yeah, so, I in fact on this topic, this is interesting. This nudge thing is taking a lot of alpha elsewhere as well. I remember there was a time when the demerger thing was not publicized, and you were able to sell the demerged entity a day before, and you can pretty much get the pick for free. I remember I got Majesco for free. Unbelievable.
Yeah. I made so much money in the Adani demerger. Those 4 companies were demerging, and some people did not adjust for that, and that day it traded so high. So in the first 5 minutes, if anybody was aware about that, would have minted money. But because it was such a big merger and so many demerger and so many people lost money, SEBI then got into its act and said that whenever the demerger,
that was the trigger, I think. Yes.
So the Adani was the trigger, and then they said that the first hour will be book building, so that randomly people don't similarly, and now the book building happens just like an IPO. So that opportunity also went away. So again, the market is becoming more efficient. That's how things are.
So how does your portfolio look now compared to what it was? significant time was going into risk
So,
arbitrage. That's not happening.
I've also recently talked about this. So, purely from a bucket point of view, there were three strategies. One was long investing. There was the option portfolio that was still small for me at that point of time when I gave going back to 2016, and there was the much bigger special situations portfolio. So, as things started happening, and I realized ki over a period of time, you want to generate a set of returns which are not coming. And I always saw the special situations and the options portfolio as something that will generate income for me. So as a full-time investor, there was always this thought process that you need to generate monthly incomes. And this is again driven back by what happened in 2008. So you should not get into a frame of mind if the stocks are not giving a return, you start questioning your basic premise that can I eke a living out of being a full-time investor. So once that happened, and then Siddharth, by the way, is my junior from my college, IIT Delhi, and we met in one of those seminars, and there was an immediate meeting of minds, and in many ways he was also at that point looking to become a full-time investor, and many things fell in place. He decided to move into Gurgaon, and we started sitting out, and we realized that there's much in common there's much not in common also, but the point is that we both wanted to be full-time investors, and we both wanted to generate income in order to have stability in terms of our setups.
I think the basic crux was same. Both of us respected risk, and we understood that we want to grow our capital over time, but in a controlled risk manner. We don't want to take unnecessary a lot of risk. We cannot go back to base zero. We cannot afford to blow up our capital, and we would also like to at least have some consistency in the returns, at least on part of the capital, if not all the capital.
Can you elaborate a bit more on your commonality on risk, and what do you think about risk? How do you think about risk in general? And define it from both the buckets, all the buckets that you're talking about.
Siddharth before this has worked in risk in large institutions and hedge funds. So Siddharth, just give the context.
For the context that I see risk is in ki, my risk is not the volatility of the returns, but it is in fact something which would prevent me to whatever goals I have in my life, whatever day-to-day lifestyle that I want to do. I don't want to do anything which has even a low probability of disturbing that. So I have an aspiration to grow my capital, compound and grow over time, but not at a cost of something that I cannot maintain my day-to-day lifestyle. So the risk for me is taking decisions that that you take a loss so big that you cannot continue on your day-to-day life, and it impacts your decisions for future. You start questioning yourself whether you want to invest in a particular way or not, so basically that is sort of avoiding a black swan event or something which may not be mathematical, right? It is especially when we're trading in options, right? So you have to be very cognizant of risk, because all the risk may not be very quantified.
Sure.
Because a lot of people believe in Greeks, delta, gamma, vega. There are various Greeks which try to capture various aspects of option risk, but there are scenarios which may happen when these theoretical values may not really protect you. Overnight things may change significantly, and you may not even get a time to react and adjust your books.
Sure.
So overall, consciousness about what your exposures are, what could be the extreme worst case, which mathematically you cannot model, but if and whenever a very low probability event also transpires, hampers from continuing what you really want to do. So that should not happen. You should be aware of that.
Okay, just let me combine these 2 point of views. One, the way you're looking at risk in the option bucket is because there is an element of booking and taking the loss at the end of the option, right? Whereas in equities, as you said, volatility we don't really bother about. There is, even despite a crazy drawdown, the tendency of stocks is to go come back, especially if you are in good stocks and right.
Absolutely.
So risk has to be seen differently from that bucket to this bucket. I remember in previous conversation you told that your definition or the way you think about risk changed dramatically post your 2008 experience when you lost 70% of your portfolio, which was 90% in equities. How does risk from stock holding perspective? Do you marry this thought process, which is option में loss नहीं लेना है, same there, or there you go ahead with the same thing? I can take the loss, or I can recoup by holding the stocks.
Yeah. So again, going back to 2016, speaking to Siddharth, there were a big macro overview about what risk could potentially be. I did not think about it. I would think about the risk in a trade. But a risk on a portfolio is something that evolved with my conversations with him over a period of time. So we started thinking in terms of what the overall portfolio would look like. And we, so special situations portfolio was, I had a track record by then. I had been doing it for 8 years. And I was pretty sure that I will not have a negative year in that. I had the track record, and given the risk reward that we understood, we knew. It's just that the opportunities were no longer there out there to constantly deploy capital out there.
Right.
So then we started thinking about options. Now options, just the nature of options is such that you can have infinite set of strategies and risk exposures by just combining so many ways of doing things. You can work on the Greeks, simply build portfolios, and a lot of quant strategies are built around Greeks. And then there are ways that you can just take naked exposure, but where the risk is pretty high, but so are the returns then. And then there is this philosophy of buying versus selling options. So all these, what we realized is that, we started actually going out and networking among the option circles, the so-called option traders. And what we realized, those guys were talking about making monthly returns which were pretty high, in the 5 to 10% range on a monthly basis, which was pretty high by the long investing standards. But when we delved deeper into it, there was a attendant risk involved in those strategies.
Right.
And we wanted to make sure that maybe we don't generate those returns. What we want to make sure is we don't lose big on these.
Got it.
So our entire portfolio construct on the option side has been done in a way that we can limit our drawdowns. Trading in options has inculcated this habit of trying to understand drawdowns. The entire terminology that from the high in your portfolio you have, what is the maximum low you can go give by following a certain strategy or a set of strategies. That is what will determine the risk of your option trading portfolio.
So that
Sorry, just 1 second. Before we, because we're going towards the option, I just want to close the stocks for the side
Sure,
ones.
sure.
So, is the same philosophy of drawdown avoidance also being carried to the equity portfolio? And
Yeah.
if yes, how are you? Because in equities, you have to think that there will be a bounce back. You're not selling.
So equity, the inherent risks are always there. At least I'll let Siddharth talk about his way of doing things. But in my case, the way I'm mitigating is in 2 ways about the drawdowns on my long portfolio. I shift money from my long portfolio into my options portfolio as the market keeps going up.
interesting.
So when I feel that the market is no longer cheap, I will sell something in my long holdings, and that money straight away goes into the option portfolio, where my basic construct is I don't want to lose money in a year. I may not make too much money, but I don't want to lose money out there.
And how's this call taken?
So this call, the basic construct I have is we have 3 on the index level. Nifty is the basic index that we have. We have 3 metrics that are published out there. One is the price to earning, price to book, and the dividend yield. What we realized after backtesting, we talked about this also. What we realized is the most stable indicator is price to book. So if you take out the 20 years data, and you can tell on a percentile basis where the indices are, and we start thinking about taking out money once we cross the 70 percentile. And as 70 to 80 percentile it hits, we'll take some more money. this construct is a work in progress in the sense, but broadly what we want to do is after 70%, at least I definitely want to take some money out and put in the option portfolio. With the basic premise that once the market corrects and again goes below 50 percentile, I put the money back into the long equity from the options portfolio.
Interesting.
So, and that is one construct. The other construct I just want to highlight is we also see in terms of two buckets. One is the small caps and one is the large caps.
Sure.
So, and one indicator what we have done is we have mapped the ratio of BSE small cap index to Nifty and seen that ratio, how it's performed. So, it definitely lies in a certain range. And based on that range, there could be decision points where we say that sell some small caps, move to large caps, or vice versa.
So this actually brings me to the question that I always wanted to ask you, Gaurav. Has there been a style change, a drift? Because is it safe to presume that there will no longer be 100 baggers in your portfolio?
Absolutely, absolutely. So definitely, I was extremely lucky that I had two ideas in my portfolio at an early stage in my investing career that ultimately turned out to be 100 baggers. Now with the experience of 2008 and all the trials and tribulations I've gone through, what I've realized is that thinking of in terms of 100 baggers is just a lottery, nothing more. 100 baggers don't happen by themselves, one. And the other thing is market is much more efficient. The fact of the matter is that it took me 3 months to buy a Ashiana stock because it was so liquid when I was buying it in 2005 and 2006. So for 3 months I could be there in the market, just keep buying after having done my scuttlebutt and the diligence on the stock. Now, if anything interesting comes up, if you don't act within the next day or two, somebody else would be onto it. So you don't have those long periods of time where you think you want to allocate big. The ability to allocate concentrated amounts on such stocks, at least I don't have it. Partly it's also the reason that the portfolio has grown. So the absolute numbers look different than what they used to. But partly it's also the fact that you don't have the luxury of time in order to kind of refine your hypothesis. And I never was the guy who would be the first one to find stocks. So I needed.
Nothing stays hidden for long.
Yeah,
nowadays.
so nothing absolutely. That inefficiency has gone away.
Yeah.
And I was never the first. But earlier I had these windows to keep on buying with the basic assumption that I will keep getting at these prices. But now you have to basically fire and then think after it. If you think and fire, half the time you miss the opportunity.
Siddharth, will it be similar for you in terms of asset allocation decision based on a Nifty valuation? Because I'm guessing you guys talk together.
Yeah.
Will you be pulling the same triggers which he'll be pulling or something different in your portfolio?
So the tools are similar, the decision points are slightly different.
Okay.
So I think it is also a function of personal risk appetite. So I would say overall terms, so I have a slightly higher risk appetite than Gaurav. I have a higher willingness to take drawdowns. So, but I think amongst the two, I'm also more quicker in taking decisions that I need to take. So when I see risk, when I'm a little bit more flexible in turning my decisions or take corrective actions.
That comes
as you
from
could
your
say.
risk.
From my risk
experience.
management days, professional experience. So I think which is why I'm willing to let a little, higher exposure runs even when I feel the market is slightly overvalued, because I know I can cut my exposures a lot faster when I feel the time is demands so.
Just to expand this equity side, and so basically what I'm getting from you is that your risk control at the equity portfolio is basically happening from asset allocation, that you are moving capital away from the equity portfolios to your options where you are defining risk in a separate way altogether, right?
Yeah.
There is also a big difference between what Gaurav and I do in equity. Gaurav is a lot more concentrated in his equity portfolio, and I am lot more diversified. So what I
Yeah.
would typically have 25, 30 names in my equity investments, but Gaurav would have a
Actually,
relatively less.
that was precisely where we are coming from. Ki asset, what is your construct? So when you said you are diversified and he is concentrated, and both of you are using similar tools, which is Nifty valuations.
For
You also
allocation.
for allocation, yes.
We are experimenting a lot with other
Sure.
tools also, but these are the ones that for now are defined in our construct
Sure.
right now.
And from what I know about you, you have always been a small cap oriented investor.
Yeah, absolutely.
To a large extent. So how do you deal with the dichotomy where small cap and large cap giving you a signal of, let's say, expensive and move your equities away, small cap on the other hand giving you a signal that, okay, don't do that. Are you shifting your indices also for your decision?
So the decision about allocation of how much money to be in long and how much money into options is driven by the Nifty levels, not by the small cap levels.
Okay.
Because that what determines the overall levels of expensive or the overall sentiment of the market.
Sure.
So, but they could be times when the Nifty is not also not too expensive, but a rally has come in the small caps, where we feel that the small caps compared to historically where those valuations were, now small caps have done. So 2016-17 was a big period of outperformance of small caps. Now, if you see in those charts, you can clearly make out that those are outlier periods. And if the simple decision could have been, and Nifty wasn't very expensive at that point, so you could have simply shifted out of the small caps into Nifty, and that would have been an excellent decision because post 2018 to March 2020, small caps drifted down in a material sense by 20-25%, whereas Nifty went just sideways. So that overlay really kind of made us realize that it makes sense to start thinking in those terms.
So and there is another realization that when you are you have large position in small caps, it is much easier to sell on the way up rather than the way down. So you may not pick the top, but if you decide to wait for the top, then getting an exit also may not be very easy in small cap companies once the either the business or the environment changes.
Sure.
So once it crosses, fair bit above your valuation threshold or expectations, and you seeing a few years of earnings are already priced in. So at least I would prefer to keep on selling in small.
So which reminds me, yeah.
On the way up rather than wait for the way down.
So Siddharth did not have a 100 bagger, but he had a 50 bagger since we joined. So maybe you can talk about.
So this company is called Swiss Glass Coat. It has the new name is now HLE Glass Coat. So this is India's second largest manufacturer of glass-lined reactors and filtration system. So I think it was an interesting story because I think at that time I used to hold stock in a company called GMM Pfaudler. This is about I think 2016-17, and if you look at that period, a lot of chemical companies were expanding their operations in India, and everyone was doing capex. And for any of these capex, whether it is in pharma APIs or chemical companies, you need inert reactors where the reactions actually happens. And there are very few companies, specialized companies in India, which manufacture these. So if you want to expand a plant, you cannot put up a new capacity without these reactors, and there was immense demand for it, and the lead time was as much as 6 months, 6 to 9 months backlog was there to get the reactors done. All these reactor manufacturers were in a way expanding capacities to meet up with the demand. The demand was so big, and it happened after a long time because of whatever was happening in China on the pollution norms, etc. So a lot of companies in India got good tailwinds, and if you listen to the company con calls, the chemical companies conference calls, you could make out that across the spectrum, a lot of chemical companies were expanding their capacities. So GMM Pfaudler was already doing very well, and they were hosting conference calls explaining about the industry scenario and the outlook. It was the leader, and the stock also did very well along with the earnings. At the same time, the second tier company, or not the second tier, but the competitor was a very small company, 150 crore market cap. They had a plant in Anand, it was called Swiss Glass Coat, and they exchanged hands, and our group, Mr. Patel from HLE, who it was a private company, also focusing on similar segment. They are used to manufacture filtration systems which go into chemical manufacturing setups. So they took over this company, and I went to their AGM. So because I sort of understood the industry because I was already holding Fodler. So I think it was in 2018 that I went to the AGM, and except the company employees and a consultant, I think I was only one who reached there in Anand. To it was still at 150 crore market cap company at that point.
So how do you, sorry to interrupt, how do you spot it? Just because you were
I
invested in
already,
Fodler?
already owned Fodler, and I knew that this is a competitor. It makes the same equipment,
Okay.
and the absolute market cap was so cheap. And the parent which took over, HLE, they were very well renowned for their filtration system. They were the leaders in India in that. And as a equipment, it is a lot more complex to manufacture. So it was logical to think that the guy who have taken over this company, they understand the space well, and they have the technical capabilities, they have the resources, and the market opportunity size is very big, because which was evident by what Fodler was doing and what it has been communicating openly on the conference calls. So the opportunity size was there, and there was a guy who had a proven track record of building a sizable business, being leader in the segment in India, taking over this company. So the risk reward seems very favorable for me to at least explore. I bought a few shares, went to the AGM, and I heard their plans and what they are planning to do and expand. I was quite happy from what I heard. I bought some shares more. For the next 1 year, the company did very well. The sales grew, the profits grew, but the stock price did not move. It was still the same after 1 year. While in the same period, the Fodler price would have gone up, I think, between 2 to 3x in that period.
This AGM was when?
So first was one is I think in September 18,
September 18. Okay. So that's when you bought the second lot, which you
the
bought.
first lot.
First lot.
And the second one was in September 19.
September 19.
September 19, I think the price was roughly around the same, maybe, I mean, 10% up or down.
And just for the benefit of the listeners also give a quantitative picture to the business which they acquired. So what was Glasscoat doing it till then? Was it a profitable business?
It was profitable. I think at that time their sales was roughly 100 crore or something, around that.
Decent ROE business, no debt kind of.
Decent ROE. They had a smaller growth.
Okay.
The growth rate was lacking. They were not going at the same rate, maybe because of the transition that happened. The new management was coming in, taking some time to understand their plans and put up their plans. So there was a small gap there. So which is what I wanted to go and understand, that what is.
Yeah. So why I'm asking this question is primarily because what were you betting on? You were betting on that HLE people will be able to take or explore the space, expand much better in a space which they were not able to do.
See, the industry tailwinds were so strong that even a reasonable management would have done a very good job of that, because the tailwinds are so strong. The product is already strong. They were the second largest player. Swiss Glasscoat itself. It's not that the product was bad.
Yeah.
It was well accepted in the industry, and a lot of big Indian corporates, chemical manufacturers were using their products. So the product was well established. And when the demand is so strong, so why it was reasonable to expect that they would also expect from the demand tailwinds. And the absolute valuation was so cheap that the risk reward situation was very asymmetric, right? What would happen if in worst case also you would maybe lose 5-10%, right? What would you lose?
Broadly, what was the range of valuation?
So this was less than a 150 CR market cap, 150 crore market cap at that point. And I think GMM Fodler would be maybe at that time around maybe 12 to 1400 crore.
Hi friends, I hope you're enjoying this particular episode. I just want to take a minute and thank the sponsors for this episode. Stoic Talks was built on a premise of actionable insights and detailed questioning, and that usually requires the independence of doing that work. When you're looking for somebody to partner with, you are not only looking for somebody who will share your ethos, but also will promote this independence of asking fearless questions without any hesitations. So when we were looking for someone like that, the obvious first choice for me was a DSP mutual fund. I have known their team. I have worked with them for a long period of time. They have this tagline called #invest for good, which I really like because it really associates, which in my observation, I've seen them living this as the way of their life, and which is very visible. If you follow their work in public, they have done some excellent research efforts. They've come up with some amazing reports which everybody enjoys reading. For example, they have this report called Netra. Then there is the transcript, which talks about the con call transcripts. Then there is the annual report Nectar, the Navigator, and many such reports, which I enjoy reading and is enjoyed by many practitioners in the investment community. So we are extremely proud to be working with such a team. They completely agree with our vision for Stoic Talks, and I really want to thank them for supporting this particular episode. And if you aren't already, I would highly recommend you to follow them on Twitter. With their Twitter ID is @DSPMF. So thanks once again, and enjoy listening this show. And company doing profits of what range broadly?
I think GMM for Swiss Glass Coat it was around 10 crore roughly profit at that time. So it was around a 10 times earning. And I expected over time with the combined group it could do much better over periods. So that for the next year, even though the sales started inching up, the margins started expanding a little bit, but the shares price did not do a lot. And by the next year, the story was a little bit more discovered. A lot of people have got interested into it because the Fodler was doing so well.
Yeah.
Because the stock price has gone up.
Yeah, I remember 2019 Glasscoat was on Twitter. A lot of people were talking about this.
People were discussing this, and then when we went to the AGM this time, there was a large group of very well-respected, independent. Still no large brokerage house coverage, but a lot of independent investors who we interact with. A lot of them were there, and we had a very good AGM, and the management very clearly articulated their plans for the future for all the shareholders. And we were able to buy as much as we want, in the next week or so. And from that price, I think maybe around that it was 180 or around that price. After the AGM also, you could buy around that price. And I think within 6 months, it was probably, I think 1600 it went there.
Wow.
And another year after the COVID, during the COVID crisis, the stock came back to 450, 500 from 12, 1300 because everything was collapsing and this was still a small company with relatively low liquidity. It came down to 450. But post another 2 years, I think from 450 it went to as high as I think 6,000.
Wow.
So effectively from 150 what we bought, it went to the high of 6,000. I did not held it for the entire time because, as I said, you keep some sense of valuations there, and when you feel it has crossed that, you start selling in chunks. So maybe I started selling after 2,500, 2,000, 2,500.
You passed some of your Ashana wisdom to.
So, but Sid's concept of selling in chunks is sell 2%, sell 3%. So it's like he'll take at least 7-8 months just to exit the stock.
I've sold the last bit. I sold on the way down.
But isn't it very against what you initially said, where you're fast decision maker? When you decided to sell, shouldn't you be like selling, getting out much quicker from your positions?
See, think about it. It is an illiquid stock, right?
Sure.
It is not that if you want to sell the entire quantity at one go, you may be able to sell, you may not be able to sell.
Sure.
If you think the valuations are very rich, but the momentum is also strong.
Yeah.
So I don't know how, I never expected it can go to 6,000.
Yeah.
So this is something I picked up from Gaurav from the last interview. Always sell in tranches. Because he did that with Unitech as well. So yeah, that's a good lesson.
So my tranches are chunky tranches, like 15-20%. His tranches are like
even
2 to 5%. So.
You bought in tranches also.
But
every
an
AGM.
important lesson around that is we have started following the concept of a trailing stop loss. So never say that this was my target price, it succeeded, I'm going to be out. Now you say that the market is, the momentum is carrying in a zone that I can't understand. I don't think it's valued. But why do you want to fight the momentum? So rather than say, then we started the broad, still it's a work in progress, but other parameters like say a 50-day moving average or a 100-day moving average, don't sell it till it's above that price. Those kind of logics do work out when the stock is getting re-rated in a material way.
Right.
It is still very difficult to to very strict when sometimes you see obscene valuations. It is very difficult to resist that urge to sell something, right? So, and especially when it is in a liquid stock, a small liquid company, at least I'm quite satisfied. If I got an average price of 3,500, so I'm happy. Okay, this was a satisfactory return.
Uh, a question to both of you. Given that you're exploring this concept of trading stop losses and giving momentum the benefit of doubt, and you are doing transient selling in the sense that you're selling in parts, do you also have multiple trailing stop losses that, okay, I'll send 5% if it goes below 50, let's say, just for example, or you have a hard code that below this we are going to sell all?
So selling, if the trailing stop loss is breached, is selling all. Then it's not in tranches. But you may end up selling on the way up also because you just want to book some of your profits.
Okay.
And I didn't have I've had a couple of 10 baggers, but I didn't have the kind of a 50 bagger that Sid had. And again, in my case, what has happened is also that my risk appetite has gone down with time. So this ability what that the pool that is already there, how much of risk do you want to expose it to? So to that extent also, my allocations are not that concentrated as they used to be.
I think for me, the answer would depend on. It is a little bit contextual in terms of which business. It is not. It is the same answer for each business that you own.
Sure.
So there are certain businesses which I own, which if they fall 20%, maybe I'll buy more rather than sell. It is contextual. It is not that every stock, if it hits a stop loss, we are going to sell. If I really understand the business and the management, and I'm confident, even if it falls 20%, I'm not going to be a seller there.
Right.
So it is, I think, so familiarity with the business and with confidence that you have. I may not buy, but I will also not sell. And sometimes if my allocation allows me to permit me to buy more, I may also buy. So these concepts, they finally, I mean, it is difficult to write it down that I will do, only this. It is, and you have to, at least I try to contextualize what is the risk here. If I understand the business very well, why is the stock falling? Is it a temporary short-term problem? Is it solvable problem?
Sure.
Right. And if I am convinced that it is a very short-term problem, then I may not sell. In fact, I may even buy a little bit more.
So it brings to another experiment that we did was, so in September 2020, we read an interview that Saurabh did with Rashekar Iyer. So that book, I was very impressed, so was Sid. And we thought that why don't we contextualize? So the first time in my life, I started thinking of averaging up. So before that, I always average down. I would allocate big and then I would average down if it goes against me because तब सस्ता था अब तो और सस्ता है तो क्यों नहीं लूँगा?
Actually, I remember in 2016 interview also you said exactly the same thing, which is that you have been struggling to build a mindset of averaging up, and you always do average down or always have.
Yeah, and so the big insight after reading that interview is that you can easily average up if your initial allocation is not so high. So if you're doing an initial allocation at 5, 6, 7%, then doubling or topping up on top is not. But this concept of averaging up is you allocate 2%, and as you read more about it and get more confident about the underlying business and the tailwinds out there, you keep on allocating up. And he highlighted how he wrote Divis using that philosophy, and that worked. And I just realized I was a fool about thinking just about averaging down, but that was a big insight for me, and that has changed my perspective to some extent. But then I also realized I don't react as fast. So as the stocks moved up, I averaged up a lot on stocks, and then when the correction came last year, so my trailing stop losses were being built up on the average line, and when the corrections came, it breached those trailing down because I was no longer aware that what they were. So this ability, this contextual ability, Siddharth has a lot better than me, and so I just realized that you need to understand your own personality also to that extent, that how you are able to do that. There are strategies which work great.
But it's also probably a function of time as well.
Gaurav, depending on the market cycle, sometimes you get a chance to average down because the overall sentiment is down. But if you're in a bull run, you'll only
Yeah,
be
yeah.
averaging
So
up.
there is no one right answer, na. So that's why they call investing an art. Sometimes averaging down works very well,
Yeah.
but having learned and experienced what I have, I think averaging up is a better strategy than averaging down. Which if you had asked me 5 years back, I would have said exactly the opposite.
Interesting.
In fact, I did an analysis, so I think a year back. So I looked at all my trades for the last 10 years, all the investments that I've done in various companies, and I wanted to see, what has contributed to the returns, what has been the average return, etc. would have been. And I realized that, top 15% of all the positions that I have taken in the market in last 10 years accounted for all the profits, right?
Sure.
Yeah.
So that's the
And
Pareto principle in play.
85% positions net did not contribute anything, but the bottom 10% they accounted for a large part of the losses. So now I think in these terms that when I take an investment, I don't know whether in what range of the spectrum it will lie. It can be a top performer, it can be a mediocre performer, but what lies in my hand is to prevent a very large loss. That is one thing that I can control.
Sure.
I cannot control it, make it a top performer, but at least I can prevent it from losing beyond a certain point. And I have not seen any, in the last my 10, 15 years, whatever trading history I saw, I did not see any example of a stock which was a major loser. Finally, it overcame that and became a big profit contributor to my overall portfolio. Maybe because psychologically, once it, from a big drawdown, once you recover, I end up selling or whatever. I may not have given it time.
Shivalik Bimetal probably would be the only exception.
I
Basically,
did not buy
down
it,
the
but
dump and now,
yeah,
okay.
it is possible. But for me, it has not worked. So risk management also has to gel with your own personality and your own experiences also.
Sure.
So I know, given my experience, so I am better off preventing a very large loss.
Yeah.
Big profits will take care of themselves whenever they come. I don't know which stock will go on that side of the spectrum, but my focus is on avoiding the downside, and that itself would lead to at least 2-3% CAGR improvement, which is I think a reasonable enough for a little bit more being more risk conscious.
And you are doing that by allocating low at the start and then building the position.
Right, and at certain point, if the losses go beyond what you thought it would be, then something is not working. You reduce your position and reevaluate it, and you can rebuild your position also.
Sure.
It's not that if you sold something, you cannot buy it back again.
Yeah, in fact, this exercise that you've done, if all our viewers do it at home, they will come to a same conclusion because this is Pareto at play.
Right.
Invariably, top 10, 15 bets are doing majority of the heavy lifting.
In fact, in the same way, a majority of people who are not doing business study and let's say a momentum based approach, they also do the same risk management. The only difference is that instead of building upwards, they are controlling their risk by keeping their stop loss very tight in the starting phase and then relaxing their stop losses more as and when the the price is moving
this
up.
is a very important concept of capital at risk.
Yeah.
So you may take a exposure in a particular position which could be 10-15% of your stock, but you're only willing to say lose 1 or 2% of your portfolio size on that stock, and those are determined by your stop losses. This doesn't have you don't apply this logic in investing, but this is a logic we have learned while doing the trading aspect, and this can actually be applied in investing in a very gainfully manner, because it's not the capital that you've deployed, especially in some of the larger cap stocks, but it's what you are willing to lose on that one particular investment.
And it also brings risk in front of your allocation, right? Otherwise, you have allocated a stock, but you think in terms of capital allocation, you don't think in terms of risk allocation.
Right.
So it brings in every stock, what is my risk rather than what is my capital deployed, and that helps you size your positions a little bit better.
And in psychologically, see, in averaging down, there is another psychological aspect that comes into play, which Sid also highlighted, is this anchoring bias. So once you buy, it goes down, you buy again, and you're averaging, And you have seen so much of M2Ms on your position that as soon as you break even, there's this strong tendency to just exit.
True.
Khatam karo isko.
True, but yeah.
So you never are able to gain the upsides on it. And this Shivalik bimetal, I bought at 120, it went to 160, and then in the March 2020 crash, it went down to 22, 23.
Yeah.
But given those uncertainty, I never averaged down, and it was also the new philosophy. Now it's at a different level altogether.
You do revenge buying and you do relief selling.
Yeah. So all those psychological biases, whether we acknowledge or not, they at a subconscious level, all of that is playing
So
out.
we are not rational humans.
Yeah,
So
yeah.
we have
So
to
this-
accept our irrationality and find a way to deal with it. So practically, I can stay the course.
Let's go back again. So we have gone into stocks and stock selection and discussion around your buying or selling positions in the stocks. From the asset allocation perspective, I think both of you are convinced, and you have said multiple times also that you are convinced that asset allocation matters much more than the stock selection. You quoted Yale, David Swenson also last time.
Absolutely.
And that has led you to build the other side of the position, which is the option side of things. The reason you do options is also something you have dealt in past, is primarily because the other alternatives are not very lucrative. So if you move out of market and you move to cash, and you are wrong on your, you're early to move out, you lose a lot of opportunity cost. On the options, you said opportunity cost loss is not there. On the contrary, you can make good returns there.
So my ability to come to cash. So basically, when you're running a long portfolio, there are two philosophies: always be invested or taking cash calls.
Right.
Now the cash calls. The problem with cash calls is that if you are wrong about the market tops or the valuation, then the opportunity cost is too high.
Yeah.
For us, shifting that money into options, the opportunity cost is not so high because of the kind of returns we are able to make in options. So for us, it's a lot easier to take those kind of calls. And once in a while, you will be very right about these aspects. And when you look at combining the option portfolio and your long portfolio, and you merge the two and look at the entirety, it clearly reduces your drawdowns.
So why that framework becomes important for us to understand from the options perspective is that for you, options is acting as a replacement to your cash or debt position, and hence you would want very low drawdowns for you to be comfortable in that.
So it started with that logic, but Puneet, the funny part is that if I look back over the last 5 years, my returns in options have been higher than my returns in my long portfolio.
Interesting.
Sure, but your risk management is from a mental point
Exactly.
of view that it's cash and debt
So
equivalent for us.
this is what I keep telling Siddharth, that in options portfolio, given all the strategies that we have experimented it and what we have built around, we will not now have a year where we will lose money.
But you said that
Wait,
for
this
risk
gets
arbitrage
very-
also.
This gets interesting. So,
This arbitrage, we are not losing money. It's just that we don't find
Opportunities
the
don't-
opportunity
We
to
won't
make
get
money.
money.
We're not
Matlab-
losing money.
It was a joke. Like 2016
The edge has
May,
gone away. Yeah,
we
yeah.
had this conversation and Gaurav said the same thing for risk arb position, that you haven't had a losing year for risk arb.
Yeah.
And then all of a sudden the market became so efficient that
So
things
again,
went
risk
well.
arb, just that. So ultimate negative year, so yeah, you won't have even if putting money in a FD.
Yeah.
But point is that you need to have a certain threshold on that. So risk arb, again, you won't have a losing year, but the
little
returns are not
opportunities.
exciting enough now.
Sure. Yeah.
So to
Just-
ensure
just-
that the risk is in place, and Sid alluded to that in the earlier conversation as well. Tell us, what kind of leverage are you taking in your options book?
So leverage. So there are two kinds of trades that we do. Broadly, two kinds. One is that what we called as our covered calls. So covered calls is backed by cash. So you say if we have 10 lakhs worth of exposure, cross exposure in the market, which is you have bought 10 lakh worth of cash futures. So you have 10 lakh cash also available. So you're not taking any leverage on that because it is a directional bet. If the market corrects, you will have M2M's losses as per the market, and so we don't want to take any leverage there. But other than that, what we have is non-directional trades, which are in Nifty and Bank Nifty.
No, so, sorry to interrupt. Within the covered call,
Covered calls, there is no leverage. All the positions are backed by cash.
so it's almost
1x.
1x. Okay.
There is
Okay.
no leverage.
So you're selling the calls equivalent to the cash that you, the long position that you have.
So calls sold could be more than that, but that is active risk management. So there is also, if in terms of risk, in a way, you could say ki if there is a gap up tomorrow, we are net short market to some extent.
Right.
But then we also have an equity portfolio also,
Interesting. Okay.
which is naked, right? Where you don't have any calls written on top of that.
So would you say they're equal?
They kind of hedge.
correct.
It acts as a hedging mechanism. The risk, see, covered calls, what happens is that, as you pointed out, the leverage is, if we have, say, as you pointed, 10 lakhs, so we will only buy 10 lakhs worth of stocks and use that stocks as margin. So there are two ways to do it. You buy the stocks, you pledge them as margin, or you buy liquid funds,
And buy it in
pledge
futures.
them, and then you buy the underlying exposure in futures and sell on calls on top. Now the calls on top are not 1:1 ratio. The calls sold are more than the futures.
Right.
So after a particular point, we are net short on the market.
Right.
Now, so that's a attendant risk, but we have a natural hedge to that attendant risk because we have long portfolios.
Got it.
So we don't have that risk that a pure covered call portfolio, a typically person who's running a pure covered call portfolio would have, because we are not going to be 100% in covered calls.
Got it. I
the
was just
position
asking,
level
is that
you will be-
1:1?
Absolutely. The allocation between covered calls, this portfolio and
The long portfolio.
and the long portfolio is going to change depending on where we feel the valuations are.
Interesting. Got
This is a moving target. It's not always 1:1.
And plus you actively manage the whole thing.
Yeah. So we
we are
actively
actively managing.
Let's again go back to the top again. So option is decided. Your money going into options is your asset allocation decision.
Correct.
Option being a cash equivalent for you, at least psychologically from risk perspective, you would want your option portfolio as such to have very defined and very low
Correct.
risk,
Risk.
right?
Yeah.
So you're managing your option portfolio risk
So
at individual level. So how do you balance that part? Like creating different buckets, and how are you managing risk at different trade positions, or at each individual position you are managing the risk to?
At
So-
the portfolio level.
at a portfolio
So
level,
how do you do that?
Yeah, so there's this concept of a drawdown. In an option portfolio, we are always looking at what are our drawdowns. So at a strategy level, at a portfolio level, so we are measuring our returns every week, every month, every quarter, every year. So those drawdowns are immediately get highlighted, and if they are beyond a certain range, we decide to move out of those strategies. So, and those strategies are not a constant. Some of those strategies evolve to grow bigger, get bigger allocations in our option portfolios, but we are always striving to look for more strategies. And and this has been a constant over the last 3 years. We have always tried consciously to look at newer things, ways of doing things.
Can you break this down? What kind of strategies are there currently in your portfolio?
So
Top two,
covered
three,
calls
four?
we have talked about. Majority of the money lies on that, but because we are only taking 1x leverage, okay, we have a lot of spare margin lying with us.
Sure.
So what to do with that margin? And that margin is what we aim to deploy on the other strategies, which are non-directional and which are largely on the indices, which is now there are 3 indices now: Nifty, Bank Nifty, and lately there is this new index called Fin Nifty. So between these 3 indices, all those strategies are built around. So these are the underlying, and where there is a weekly expiry.
Great. And so continuing with my first question, what's the leverage on that?
So there the leverage, we don't think in terms of leverage because it is not an unhedged trade.
Okay.
So all the trades where any option that we buy would have a corresponding, so any option which we sell would have a corresponding buy bought option. So you would know your worst case loss, what it is. So even if there is a market gap up or gap down, you know what is the amount of money that you can lose, and that money for me is roughly 1% of the portfolio. If there is a gap up, I can lose roughly
Achha.
1% of the amount.
Very interesting.
So I haven't measured it like that, but as he rightly pointed out, this is hedge. So again, these kind of trades are two versions to it. One is intraday, that you start those trades in the morning and by 3:30 they are over. They are squared off. Whether there's a profit, whether there's a loss, they are squared off. So there is no concept of a gap up risk or a gap down risk.
Right.
So the only risk is during the day. Then there is another set of trades which are positional, which we will carry to the next day.
Right.
Now, in those trades, for whatever we might have sold in an option, we would have a correspondingly bought option. So nothing is naked out there.
So your tail risk is covered.
So the entire concept of cross leverage doesn't count there, because we are measuring our max losses,
Got it.
not measuring how much of gross exposure we have.
So
In fact, typically we would end up having some, spread trade spot, which is out of the money as, just tail additional protection. So if we have a down circuit tomorrow, so most probably we will benefit out of it rather than losing money, because you have some these cheap extra protection spot which can benefit you.
So this brings me to this question that I keep getting asked, that if you are doing these hedges to ensure that fat tail risk is covered, is hedged, what are the ideal return expectations after you have hedged yourself? Per month?
So I think with our per month is difficult to say.
More on
Per day,
per year is a better
Per year,
benchmark.
Per year, I would think post hedging, 15 to 20% sort of a return is, I think, reasonable to expect.
So I'll put it a somewhat different way. It makes sense to the index strategies which are there. It does make sense to measure it on a monthly basis, what happened in a particular series or a month. The covered calls, any given month could have a loss, any given month could have a profit, and even up to a quarter we might have a loss. But covered calls, we have built it now in a structure that for the year we will not be negative. That's where the concept of those tail hedges kick in. So again, so the time frames are different, and whether we'll make more money in covered calls or whether we'll make more money in the index strategies is a function of how well the overall market is doing. If the overall market goes down, the index returns will be much better than our covered calls. But if the overall market is going up, the covered calls, because covered calls by their very nature are directional in nature.
Right.
I think there's another reason why we want to do both. See, because of what happened in, say, special situations, market got efficient over time and the opportunity disappeared. I think it is possible that for the index options, we can have something like that over time as more and more capital keeps on coming in. The size of algorithmic trading in India is increasing, and finally, in a way, they would compete for the same pool of returns. So what is the source of returns? You have a lot of these retail guys who are coming in and trying to buy options or lottery tickets, who are burning money, and they are the ones who are providing returns to people who are systematically in a strategically way selling options.
Sure.
As more and more people keep on participating, in a systematic, in a well-defined way, they are going to take away, diminish the returns for everyone.
Sure.
Correct? So as markets gets more efficient, more capital keeps on coming, these returns can get diminished over time. But I am convinced for the covered calls, it is not going to be the same. Because, to generate that return, it requires active management, it requires skill, and it requires ability to take a drawdown, which I think traders will find very difficult, and investors are used to taking drawdowns in equity portfolios.
Sure.
So our genesis coming from investing background, so our ability to handle those drawdowns is far better than traders. So most of the traders can't take 10-15% drawdown on their trading books, but for investors it is
Part and parcel of life. That's how they evolve.
Possible.
Yeah.
जैसे लेकिन ट्विटर पे तो लोग 5-8% कमाते हैं महीने का, आप अभी 15-20 साल का.
नहीं तो their skill set is different. We are not as
तो
skilled as them.
वो 5-8% गवाते भी हैं, तब वो ट्विटर पे पोस्ट नहीं करते. So point is that we want to live that life.
Yep.
So we looked at our data. So for option trading, so I've been capturing my monthly data also, because a lot of these trades, non-directional trades, whatever we do in index, are weekly expiries, and any particular week can also have a loss. But for the last 3 years, I have not had a negative month.
Nice.
So since the time we scaled it up a little bit, उससे पहले तो we were not even tracking it as quickly. I have not ever had a negative month. And on average, returns have been better than what we have expected when we ventured out.
Sure.
So,
So when Sid points out it's 15 to 20%, we have been doing better than that.
Of course, you've been conservative, yeah.
But in the long term, that is where we
so
expect
it is
things
same
to
as
trend.
what you say. You ask a mutual fund investor, how much should you expect? You would say 12 to 15% is what you should be happy if you get in the long term.
Sure.
So similarly for options, if you get 15% after hedging, you should be happy. Of course, you can do better.
And again, going back to the original objective, it is cash equivalent. 16 to 18%
Yeah.
is
So
extremely good in any kind
at
of
the very
market.
core of us, we are more investors than traders.
Yeah.
We also run this fear of that as market has turned efficient, say in special situations, it's going to turn more efficient. Currently, what is feeding this frenzy in this jump in option volumes? Like NSE as a derivative exchange is the largest in the world right now.
Yeah.
And for a fact, given the demat accounts that have opened, the trading accounts that have opened, especially with the new age brokerages that are out there, they are running into tens of lakhs on a yearly basis. And all these people are coming out with pools of 50,000, 1 lakh, 2 lakh, 5 lakhs. So this is the amount of money that is adding to the profit pool.
Right.
Ultimately, trading is a zero-sum game. For somebody to make money, somebody has to lose money, and then there is the brokerage, there is the NSE. All the profitability of NSE is being driven by option trading right now.
Yep.
Yeah.
So this can't continue forever. So people who are the fodder or the sheep that will lose the money in order for others to make money, ultimately, as an individual, they'll run out of money.
So
Then
you're
they're out of the
concerned about the supply of the sheep.
So the supply of the sheep is going to disappear. It's pretty much logical the way you are going to run out of people you can take money away from.
Yeah, true.
Hopefully, they get wiser too.
See, think about it. As a HNI investor, if I'm doing a strategy which I believe in initially, but I start losing money, I may continue it for a month, 3 months, maybe a year. But after that, I'm going to stop.
True.
Now, I've stopped losing money. So the one who was making money, where does he get his profit from?
Sure.
And it's this new supply of newbie traders that are going out, which is supplying the profit pool. That profit pool is bound to go down. That's the belief that we carry over a period of time.
Even if it doesn't go down, it is difficult to see it will keep on expanding, and new capital will keep on coming. Systematically. More and more people. Even our own compounding will keep on happening over time, right? Our size of option book has increased significantly what it was 3 years back.
Right.
Right. So where will do all those?
With these kind of returns, more and more money, it's going to attract more money.
Well, it is possible we may start thinking why the opportunity cost of investing is too high. Options is much better.
It's easy to think like that. It's the opportunity cost of not putting money in options rather than in investing right now.
True.
Right.
True.
And there's enough chatter on Twitter for you to have an idea the kind of money. There is a firm in Gurgaon called Graviton. What we have heard is that their yearly profits are more than 1,000 crores. And
Wow.
that is just one firm. And there are dozens of such firms now.
And all they are doing is options books.
Exactly. There is a listed company, two listed companies that are
listed
trading,
companies,
Share India and Daulat Algotech. Just
Yeah.
look at their numbers. So where is all this profit pool coming from?
Sheep and fodder.
So anyway, those are larger discussions. This
Sure,
is something that Nitin Kamath of Zerodha also keeps highlighting that
Yeah.
ultimately.
Stoic Talks has been partnered by DSP Mutual Fund, which was an obvious choice for us, having worked with the DSP team earlier and recognizing how they're obsessed with helping investors take better decisions. Some examples of their motivation to help investors do better are visible in their research related work, which they make available for free, including Getting Smarter, Tathya, Report Card, their Invest for Good blog, among others. We thank Team DSP for supporting this episode of Stoic Talks and recommend that you follow them on Twitter at DSPMF.
So is it fair to say that you believe that the algos and that side of the world, which is getting those fodder, the sheep which you're talking about, those alphas will go away
over a period of time.
Over a period of
I
time.
think a more evolved market is US. US doesn't make these kind of returns on option trading. So
Even
there
the
the markets are
discretionary even the
they
discretionary
are
ones?
like
At size, it is difficult.
so
to get
so
Yeah.
there are firms like Two Sigma or Medallion Funds. matlab, they are doing so much of these high frequency traders. Nobody can make the money like the way they can. So they have already taken out the low hanging fruit out there. You have to be so there the market is more efficient. If you want to make higher returns, you have to take more risks. What is happening right now in India is you're not taking that much risk to make these returns.
Right.
And it will not last for a very long time. It may not last. I don't know.
No arbitrage lasts forever. So what the hell?
Well, that's our basic expectations, but we are happy till it continues. So
Okay.
Right.
So, okay. Now let's come to the strategies again. Okay. So
sure.
you said covered call is primarily taking majority of your option portfolio. Is that a fair assessment? or
The
something?
largest strategy, I would say.
So basically, it is
How much
sized at
of your-
1x. Whatever the option pool is, at 1x of that gross exposure is covered call. That is how it is going to be.
So if we have 1 CR, and we have 1 CR gross exposure, but the margin involved in running that pool, because it's levered any which ways, I would say about 40 to 50 lakhs is still free for us to do other things.
Sure. Why don't you explain this covered call in its entirety from how do you engage in, at least with one example of a trade? One example which will cover all the aspects of covered calls from margins to whatever you do in a position.
So the broad philosophy around covered calls is that you fundamentally look at stocks. So covered calls is limited to stocks which are there in the F&O segment, which are broadly about 200 stocks. The stocks are selected by NSE on certain criteria, which is the liquidity, the market cap, and gradually it's grown. Out of this, practically the liquidity in the options is only in the top 100. Below that, the liquidity are so low that it may not make sense, because you want to deploy capital at a certain scale. So out of those, maybe the 100, we take a fundamental view on the stocks. Okay, so I'll come to the current construct. Is our initially 2/3 of the portfolio has to be built out of the Nifty 50. And why I say why that constraint is there is simply because we want to hedge our portfolios to some extent. And we need to have a correlation of our portfolios with Nifty, because the hedging tool that we have is only Nifty.
Okay.
So we want to have a correlation, and that's why we have put in a filter that 2/3 of our stock holdings have to come out of Nifty. So out of the Nifty stocks, we do our allocation typically in terms of the portfolio construct. And before saying this, I'm not a SEBI registered advisor, and doing this only out of to share my experience and for educational purpose only.
Sure.
So this should not be taken as any kind of advice. So to that extent, what we do is we would construct a portfolio of 20 stocks. Out of those 20, maybe the top 12, 13 are going to be out of Nifty. And in Nifty, we are basically fundamental guys, and we would take a view what stock is cheap or reasonably priced, and those are the stocks we'll focus on. And once we select that pool, we buy the underlying share, and currently we are not even buying the underlying shares. We are giving our money as a margin, money into liquid funds,
You buy liquid funds.
and pledge those liquid funds to get the margin. Then we buy the future of those stocks, and then sell calls which are far out of money. So the calls from the current market price would be 5 to 10% away when we start the trade.
Okay. So just for the clarity of everybody.
So
who's
to
listening.
give you a specific example, say DLF.
Yeah.
So DLF is at around about 400 rupees right now. If we buy the future at 400, we would like to sell the call at either the 430 or the 441. So about 10% away.
Okay, sure. So just to give a the broader clarity again, when you are saying you're taking 2/3 of your portfolio from Nifty stocks, you're talking about the equity part of your
No, the futures.
or the complete option book mein you are dividing.
This is just the option book. We are not talking about the
So
investing.
that part is done. You're not talking about equity anymore.
Yeah.
Whatever allocation you have decided to go to options, there you are putting covered calls. In that, the stocks are going to come from Nifty 50.
Yeah,
Two-third of the
Two-third
stocks.
of it,
And rest will be from.
and this is
lower
purely
levels.
fundamental views. We are not using any technical aspects or charts in order to shortlist those stocks.
Sure, but then since majority of your money is gonna come when you are shifting the money from stocks to options, right? Which is the peak of the markets, expensive zone of markets. Will you be comfortable buying those positions there? Because
Absolutely, because here we
Again,
have a
fundamental
hedge.
view, yeah.
We have a hedge.
Sure.
So that's where see the entire construct is once we build this portfolio, we would buy hedges for this portfolio, and again these are dynamic hedges where we are buying these hedges depending on where the market is. And if we feel that the market is showing weaknesses, and one of the clear indicators of showing weakness is that once the market starts moving or the index starts moving below its moving averages. So once it crosses those moving averages, we will start buying hedges, and these are long dated hedges on Nifty. So currently if we want to buy hedges, we would buy the December 2023 hedges.
And what is the cost of the hedge?
So 10% away, which is a year away, and 10% away, broadly the hedge cost would be about 3% of the strike price.
No, what is the cost of the hedge for you at a portfolio level?
So our broad philosophy is that about 15% of what premiums we are getting out of selling calls on top and all the management we are doing, 15% of that we will use to buy the hedges.
And you must have done a model simulation as to if, let's say, the entire thing cracks, are the hedges sufficient?
Yeah, so say 10% is after doing this modeling.
Interesting.
And with the caveat, because this year what happened is the market went down earlier and then it bounced back, and we ended up rolling our hedges to the next year at a very expensive level, and because of that, currently the hedging cost is higher than 15% right now. So, but that's an opportunity cost that we have to take a hit on, because there's no way we are going to remove those insurances that we have once we have built.
I think this is an area also where we would like to work more to optimize it better. So now what we have optimized it on is to prevent our portfolio drawdowns, that we will not have a negative year, and on a base case basis we still have a return which will exceed our threshold, a return expectation. But there is some scope to optimize on this cost of hedges, or do it in a better way, and this is something which we'll keep on experimenting and seeing how can we get better at it.
So how much of this can you actively do? How much can you leave it on supercomputers and convert it into algorithms? Are you trying that? Have you given a shot to?
No. So this is not what the way we do it. It can't be automated as of now.
The covered calls bit
Yeah,
that
sure.
cannot be automated.
But some
And-
part of
and
your
we don't
options can
asp-
be converted.
We
Okay,
don't
we'll come to that.
aspire this to automate this part of the portfolio.
Because he said that is where the edge also will remain
So
for a long period
we
of
don't
time.
want to make enough rules that it's automated. Anything that gets automated will attract capital over time.
Sure.
So we leave it to our learnings and that experience takes time to manage. And as he pointed out, the M2Ms and the drawdowns are pretty high in that.
And besides, I've seen you work on this strategy. This is there's a lot of discretion involved. I don't think it can be coded.
It cannot be quoted.
Matlab, we have tried to think about it, but broadly we agree, and that is also an edge. Why would we want to lose that edge?
So
Exactly.
you can have broad rules, but you still need to be very conscious of the environment and the risk, and a bit actively manage it.
Okay.
It's not that one rule will suit in all market environments, all sorts of conditions.
So you guys are transitioning to algo, as I hear,
That is-
the intraday part of it. Talk us through that.
So
What's
other
the
strategies besides covered call where you are trying to do optimization.
Sure.
First, let's just discuss those strategies at all. So besides covered call, what else are you doing in your option portfolio?
So as we said that for covered calls, whatever margin we have, half of that margin is deployed, given that we are not taking leverage out there.
Yeah.
So the remaining margin is available for us to do other things, and broadly the underlying is on those. Initially there were only two indices, Nifty and Bank Nifty, but lately another index has also come into play called Fin Nifty. So there, the broad idea is on a monthly basis we want to make profits. We should not have a negative month.
Sure.
So that's the broad construct, and within those construct, we are experimenting with strategies where we say that the minimum threshold of returns that we can generate on those strategies on a monthly basis is like between 1.5 to 2%, and let's put it 1.5%. We are happy if it's more than 2%, but minimum 1.5%. So any strategy which has acceptable drawdowns and is generating more than 1.5%, we would want to scale it up.
Provided the risks are in control.
So
Any example you can share, any strategy you would want to share?
so again, so
Or you can
ratios.
share the one which has lost the edge and it worked for
No,
you.
no. So one is that these are discretionary strategies. So again, it
underlying
depends
thought,
on the.
underlying what are you
So
trying to
ratios, yeah, you buy one a closer strike call and you sell farther strike out in a ratio. It could be 1:2, it could be 1:3, or closer to expiry. It could be 1:5 also. So all those kind of ratios do make money, but it requires a lot of active management, and different regimes will require different ways of managing it. We actively used to do these ratios both on the call side and the put side with Bank Nifty, but as the IVs have fallen. See, another issue with the options is that the returns are a function of the volatility in the market.
Absolutely.
So as the volatility starts going down, the returns will start going up. So what we have realized is certain strategies work better in when the volatility is higher, and they don't work so well in the market. So what we are trying to build is a portfolio of strategies and try to classify these strategies that this will work better in high vol regimes, this will work better in low vol regimes, and then mix and match as per what our reading on the regime is.
How are you going about quantification of the regime itself?
IVs, they are currently like the India VIX is at between 13 to 14.
So how
So-
backdated number you look at, or you just worry about the instant
in
numbers?
March 22, it hit 82.
Yeah.
Okay. And typically, if you look at the mean values are in the range of 13 to 15 only.
Sure.
But since March 2020 till 6 months back, it has been above 20. So I would call that the high vol regime.
Sure.
And what has happened over the last 3-4 months is from 20, it's continued to fall down to 13 where it is today. So it's a very objective benchmark to try to understand. It clearly tells us the individual stocks of options are not linked to that. It's more linked to what is happening in that stock. But broadly, the premiums are also driven by overall premiums are driven by where the IV India VIX is moving.
Sure.
Yeah, the straddle price will give away the volatility. Correct.
So what we have realized is that higher vols will generate higher returns. That's the
People who are good at managing risk, higher vol will give them ability to get better returns. And people who cannot manage their risk or position size, they may have large losses also. Because obviously they are equal losers whenever there is a winner.
True.
So, yeah.
So you were telling us about the transition now moving into the algorithm versus the intraday.
So basically, one of the downside of doing these discretionary weekly strategies is it takes away a lot of your time, bandwidth. And because something which is discretionary, it is difficult to outsource or scale also.
Sure.
I mean, if something is more systematic, it is easier to train a dealer who can trade for you. But something more discretionary, you have to be always on top of it in terms of risk management and looking at it. So which becomes also a challenge to scale beyond a point unless you are committed to giving your entire time and attention to that strategy. So I think that is also a realization after spending a lot of time in option trading over the last 2 years. It came on to us that this is not something which is sustainable for us for a very long time. That this is not how we want to spend most of our time active time during the markets managing option positions. So this prompted us to look at what are the other alternatives available, and algorithmic trading, on non-directional algorithmic trading seems to be something which suits our requirements. It can we can design the algorithm, we can backtest it, we can see how the performance has been in the past, and if it meets our thresholds, we can slowly start deploying it. That was the thought behind it, and we started this project almost a year back, and gradually it has done all right. I think we have developed a bouquet of strategies. All these are non-directional strategies, so basically we are not taking any view on whether the market will go up or down, and a lot of these algorithmic strategies are also intraday. So the algorithmics take strategies during the day, and by the time, by the end 3:15, 3:20, everything is covered.
Okay.
So, and the risk is measured by the drawdowns. Historically, what the backtest has shown, and we haven't had a long operating history till now, even though we have backtested it for 4-5 years. But the operating history is only around 9 months, and out of that, only 4-5 months at a bit of a scale. In the earlier few months was also at a very preliminary stage, a small testing stage life. So till now the drawdown has been very reasonable. It is lower, but it is not a long operating history, so we can't.
What
say.
about the backtest history? What has been the drawdowns there?
Backtest for the model that we have, it shows us the worst case drawdown, historical drawdown of 3.5%.
And this backtest is done on what? Tick data, minute by minute data?
1 minute candle.
One
minute data.
So,
Candle.
Okay.
what we have realized is that on a strategy basis, the drawdowns might be higher, but when you combine uncorrelated strategy, the portfolio level drawdowns definitely go down.
So at a portfolio level with a 3% drawdown, what are the return expectations in the backtest?
So the backtest says in the range of around 40%, but we'll see over time. It was also a large part of that was in a high vol regime, so the returns could have also been higher. But our threshold is 18%, right? If anything is above 18%, we are happy to give it a try.
So we continue to explore further. If it's more than 18, if the returns are not even 18%,
Then it is.
then we'll just abandon it.
Okay.
So till now we have been able to do better than that, I think.
And this part you're going to completely automate. So there is no.
It is automated.
It is automated.
We
fully
aspire to automate, fully automate. So again, as we said, at our heart we are investors. What happened is over the last 3 years, the time that we devoted to trading options was so high that the other part suffered. So we want to go back to our core research. For that we need to pull out time, and automation is the tool which will allow us to do that. So that's what our aspiration is, that ultimately automation for the intraday strategies, automation takes over.
Actually, and in many conversations in past, you have always said that majority of the investors don't do what we are doing, right? That has been a pet peeve of yours. And you said that most of the people should look at this side of the world. What will be a suggestion to somebody who is 100% investor today? What is the first thing he should start exploring into, if at all he wants to, evaluate this side?
See, my experience has been, it's been almost how much now? 24 years of investing now for me. And for a large part, I have been purely an investor. And my evolution thought process has evolved. My entire network, the philosophy has evolved around that. And it's only in the last 5-6 years that I have experimented on the options in a big way. Earlier, it was all experimental to say. And what I've realized is that while learning about options, we thought that there's a lot to be learned, and we reached out to other people who traded options. We actually attended seminars, we networked with people who we thought were good and big traders. And what a very interesting dichotomy came up, which was, if I speak to my investor friends, they just want to say that options are an absolute no-no. For most of them, they are weapons of mass destruction. That's the best way to kind of explode your portfolio. And this is across the board the feedback that I get. And then on the other side, when we speak to all these traders who are doing really well, and I think they are really good traders, but the one thing missing in most of them is this concept of compounding. They feel that for them, if they are running a 1 crore book and say maybe in a year they are earning 30-40 lakhs on it, so which are pretty good returns by that. But what will happen at the end of the year, they will take that 30 lakhs out कि with the philosophy कि मैं तो रिस्की काम कर रहा हूँ, इसको तो सेफ रखूँ, उसको FD में डालेंगे, and they will not compound their trading book. So traders don't understand the power of compounding, whereas investors who can actually improve their compounding by getting into this are strictly just wanting to stay away. And my thing is that obviously trading is not for everyone, but it's at least explore these aspects as we have explored and learned that some of the things really fit. In option trading, people do very risky trades, do all kind of blowouts happen, but we have evolved from that to learn the things that suit our personality and our ability to take drawdowns. And so many people I've talked to felt that sooner or later my account is going to blow up.
Sure.
And I've been warned adequately over the last decade. And initially I used to get calls when there was a sharp gap down. ठीक है ना तू? So and I had to explain कि यार loss है but nothing out of ordinary.
Sure.
Right.
So
people have to look at some of these listed companies. There are very clear examples how scalable this business is, and people are, even these listed companies, they are taking leverage on their equity to juice up their returns, and even on an equity base of 400-500 crores, they are doing an ROE of upwards of 40% ROE consistently for many years. So there is something there to be explored. There is something there to be learned. I think.
So let's say somebody is convinced and he wants to start. What do you suggest? What do you suggest to somebody who is saying, okay, whatever Gaurav is saying makes sense, I want to do it, what do I do?
Yeah, I think one of the key things is I don't want to encourage retail guys to think about options.
Sure.
There is a certain minimum size before you even can think about it, because one of the biggest aspect of managing your risk is diversification, and below a certain size you just can't diversify. Like a covered call portfolio, if the way we are doing is it's spread across between 20 to 25 stocks, and each contract itself is worth 5 lakhs.
Easily.
And then we are doing multiples of one contract in the least possible size, because we want to partially hedge, partially adjust. Those partial concepts will go away if you only have one contract.
Sure.
So,
Right.
so those kind of portfolios would require at least pools of 2 crore plus in order to start even thinking about these aspects.
Sure.
So definitely what we are doing is not for the retail guys out there.
2 crore of option book.
2 crores of a book on the option
On the
side
option side of things,
and people
obviously.
might purely do options, they might purely do the other part, but it requires a certain size.
Sure.
Otherwise, my take is it's just not even worth it.
Fair enough.
So all the effort it requires, मतलब वो basically as Sid keeps saying, हम तो मजदूरी करते हैं. So it requires a lot of cognitive overload and the actual effort that goes into monitoring all your exposures, and the evolution from there, which we are trying to do, is into automation. It's an evolution. It won't happen overnight.
Sure.
So a certain amount of minimum capital is there, a certain amount of respect for risk has to be there before you even think about getting at it. So what we are talking about is definitely not for the retail guys, one of it. We are talking about that this is for people who, one, have crossed a certain threshold in terms of the size, and second, understand risk or have chosen to become full-time investors.
Sure.
So this is option trading definitely is not there for part-time investors or traders. That part I can clearly say, the way we do it, it's not a part-time job.
Sure.
Sid, you want to add to it?
I think you have summarized it very well.
But
I
then-
think
What to do? Still pending. For somebody who has the capital, who wants to explore this, what do you...
to have this belief. So we are live examples. I think option trading now that we have a broad framework in mind, I think option trading itself will add a few percentage points to our overall returns on a 10-20 year basis. I believe that now.
Sure.
And if that realization was there 10-15 years back, it would have been a lot better. Do we think that these returns will go down? Yes, we do. But the peculiarity about the Indian market is that what happens in the US for option trading, you get margin. Either you give cash, or in order to get margin, if you give your stocks, so that is acts as a collateral. But any margin you get on for that collateral, you have to pay interest on it. In India, what has happened, the regime we are in, that your stocks can get a collateral for which there is no interest. So stock will give you margins which for there is no interest.
I don't think this part of the conversation should be published because they'll get an idea to take this privilege away.
But there are peculiarities in the and there is another peculiarity which initially got us into these weekly option trading. India had this concept of STT, which was at a gross level for the buyer at the day of expiry and at the premium level for the seller. And so what this created was such a huge arbitrage that buyers had to buy. They can't leave their contract open. Otherwise, they would have to pay the STT on the gross value, not on the premium value. So just to give you a case in point, say the index is at 18,000, okay, and 18,010, and basically on the day of expiry, the contract will expire at 18,001.
Sure.
So those 9 points are there, even though the settlement is at 18,000 points. Before expiry, the option buyers are willing to even sell back the option again at 1 rupee.
Yeah, Prashant Malik actually told me about this arbitrage back then, and I was like, how is this free lunch available for the writers?
It was
Actually,
there and it was taken away.
Time and then it was taken away.
We were too late into the story. we were only, I think it was there for 6 months. Once we first realized it was there. So
yeah, but we were not.
The lunch was for a bit longer.
We didn't know.
Had we known about that,
today, it would have been a very different.
It was we could have made so much of additional money. So there are these unique places. See, as an investor or a trader, your job is to look for market inefficiencies.
Sure.
And point is, more stones you turn, that is where you will find the efficiencies. So have an open mind, have an open outlook, and don't think this is kosher, this is kafir, or in those terms. Ultimately, we all are there to make money, and to say this is not the Graham way of doing things, this is not the right way of doing things, is that where I feel that we should not have these silos about investing. The market regimes change. What used to make money earlier does not make money. And a lot of people are kind of fascinated by this aspect of the early Dalal Street veterans who made money, who started out in the 80s and then made money in the 90s and now are big shots now. But the market was very different now. That thing just cannot be replicated now.
Right.
If that realization is not set in, then there is always going to be a big level of frustration that where is my 100 bagger? Why hasn't that come to me?
That's a good message to end the conversation on.
Actually, before even ending, I would want you to give some resources people can go to, refer to, learn from, which are more practical in nature rather than conceptual.
Sid, you want to take a shot? Maybe I'll add to it.
So I think Zerodha does a good shot at it. The Zerodha Varsity. They have a lot of modules. They theoretically explain a lot of things. And to learn a little bit more about strategies, I think there is a channel called Tasty Trade from US where they talk about a lot of strategies and they discuss a performance of lot of those strategies in the US context, that how these strategies has performed. They do very detailed backtesting and they try to explain a lot of these trades as well as those strategies. So that is also an interesting place to get some sense of what kind of strategies are working globally and and get some data around that. Then in Indian context, I think Vivek Bajaj, he runs a face-to-face series where he interviews a lot of traders, and a lot of them are systematic option traders who come and talk about their strategies. So even though those I would say those strategies could be a starting point to think about what all are the possibilities. And you obviously need to fine tune it and think a little bit more how can you make it better. But that's a good starting point. Listening through a lot of those interviews, could you give you a feel of lay of the land, that what are the different kind of things people are going about? And someone, I'm assuming, who is coming to there for an interview has been trading that style for some time and has made some money. So it is worth, you will get some sense of what people are doing.
Sure.
And then from those you can try to see what suits your appetite or your interest, and take it from there.
Any book recommendations?
Eugene Sinclair, I don't remember the name of the company, but the book, Eugene Sinclair has a nice book which can serve as a starting point. But it has a lot of technical. See, when I started out trading, there were so many terms. When I watched videos, I did not understand those terms. So what is a butterfly or a straddle or a strangle or a jade lizard? So these are these exotic terms that come at you and you don't realize. I think a better way for a starter is to start with Zerodha Vasti, where they have contextualized that knowledge to the Indian context. There are many tomes on options, but they are too technical in nature for people to try to complete it. They are quite technical in that aspect, and most of the approaches talk about the Greeks of options, and our approach has largely been devoid of trading options based on Greeks. So, and in terms of additional resource, there's some very good traders out there, and one guy that I'm really impressed with lately has been a person called Bandi Shreyas. Okay. He's based out of Bangalore, and he largely trades strangles on indices. But the good part is he's documented his live trading for almost a year. Where he talks about his risk management, he talks about why he does things the way he does, and he's very articulate, he's very honest, and always responds to queries. I think it's a great learning resource. It will take a lot of time to understand what all he's trying to do, but it's a good starting point.
Sure.
So I guess that kind of sums it up.
Yeah, great. Sure. So any other question, Manish?
Oh, that's it.
Lot many more questions. I think we'll go into the practical aspects of.
Yeah, absolutely. So this is there is no holy grail here. Yeah. The point is, what made us money 2 years back is no longer making us money.
I think one another resource which I would like to add is the presentation you guys gave at the CFA one. Whenever it is out, it's not out I think right now, but that was also because you did share a couple of examples on the covered calls.
Yeah. So because we made presentations and we talked about some of those strategies. So yeah, it basically talks a bit about our philosophy at this point of time in totality. Yeah.
Maybe you guys can start the tasty trade of India.
You guys need to do that. You call among other guests. We'll join you guys.
It was great. Yeah, great conversation once again. Thanks a lot for sparing time. As I told you, we always experiment new formats with you. So we are doing the video format experimentation with you only.
Thanks for hosting us, and it was a pleasure talking to you guys.
And thanks, Siddharth, for joining. After a lot of you should join more often. It has a lot of value add for
So Siddharth, I would call a hidden gem. There's many things that he understands much better than many other experienced guys I know.
Yeah, it's good that he joined in today. He was just shying away. I don't know why, but this was good.
Great, man. Perfect. Thanks a lot.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.